Geopolitical conflicts like the Israel-Palestine war don't affect U.S. stocks as directly as domestic issues like Fed policy or inflation, but they can still move markets through a few important channels. Here are the main ways investors watch for impact. 1. Energy and oil prices. The Middle East is a critical hub for global energy. Even if the conflict doesn't involve major producers directly, investors worry about regional escalation involving Iran, Lebanon, or Gulf states. Higher oil prices lead to higher fuel costs, which can push inflation up in the U.S., that can pressure consumer spending and keep the Fed cautious about rate cuts. So, energy shocks can indirectly affect equities through inflation and monetary policy expectations. Markets often react quickly to that inflation risk. 2. Defense and security stocks. Wars often boost demand for defense contractors like Lockheed, Raytheon, and Northrop Grumman. That can push their shares higher as investors price increased government spending. Cybersecurity stocks can also benefit since cyber warfare risks rise. These impacts tend to be sector-specific, not broad market moves by themselves. 3. Investor sentiment and safe havens. Markets dislike uncertainty, so investors often seek gold and U.S. treasuries. The U.S. dollar can also strengthen during these flight-to-safety moves. That can cause short-term volatility in growth and tech stocks as money rotates. Usually these are temporary moves unless the conflict escalates dramatically. 4. Trade and global supply chains. If shipping routes like the Suez or regional lanes are disrupted, global trade can slow. Higher shipping costs and delays weigh on multinational U.S. companies' supply chains. That can mean weaker earnings or higher costs for firms that rely on global suppliers. 5. Political and military involvement by the U.S. More direct involvement, aid, deployments, or sanctions, can change government spending and risk perceptions. Markets may price higher spending and debt, but Wall Street focuses on corporate earnings first, so impacts tend to be sector-specific rather than across the board unless the war widens. Historical pattern. Past Middle East conflicts show an initial shock, market dips, oil jumps, then a stabilization phase. Markets often recover quickly unless the conflict expands regionally or drags on. Energy, defense, and safe haven assets are usually the most impacted. The U.S. market is resilient, but watch sector risks and inflation signals closely. Bottom line, the conflict mainly affects U.S. markets through oil prices, defense stocks, and investor sentiment. Unless it widens into a larger regional war, impact on the overall market tends to be short-term volatility rather than a deep crash. For U.S. retail investors, focus on earnings, inflation signals, and sector exposure, not headlines alone. Stay informed, manage risk, and keep a long-term perspective.